All right, we began the show with discussing about gold. Gold prices continue their dazzling rally as markets remain clouded by US President Trump's escalating tariff agenda. The yellow metal firmed again on Tuesday, inching closer to its record high, driven by investors seeking shelter from volatility fueled by trade tensions and looming geopolitical risks. Spot gold touched a peak of $3,245 on Monday and held close to those levels. US gold futures also gained, reflecting strong investor conviction in gold as a defensive asset in uncertain times as Trump signals fresh tariffs. Global markets are bracing for more disruption, with investors hedging their bets by shifting towards traditional safe havens. Major brokerages have taken note of the ongoing rally. UBS maintains a bullish outlook on gold, citing persistent macro uncertainty and central banks' cautious stance as key drivers. The brokerage sees continued upside, particularly as the Federal Reserve holds off on rate hikes amid the policy fog created by tariff threats, with yields stabilizing and inflationary concerns still alive. The non-yielding asset remains a preferred choice for conservative portfolios. Goldman Sachs, meanwhile, expects gold to maintain its upward trend as long as tariff anxieties linger. The firm has pointed to the growing disconnect between market optimism and political unpredictability, suggesting that demand for hedging assets will persist through mid this year, 2025. Supporting this momentum, inflows into Chinese gold ETFs have surged this month, outpacing US-listed funds, reflecting a global pivot towards precious metals and currency and equity market jitters. While other metals showed mixed movements, gold remains the standout performer as the tariff narrative deepens. The question is no longer whether gold will shine, but how long will that glitter last? All right, to discuss this further, I'm now being joined by Mr. Ajay Bagga, who's a market expert, joining me live from Mumbai. Mr. Bagga, always a pleasure having you here on World Business Watch. Sir, given the recent surge in gold prices, do you see this as a temporary spike driven by tariff uncertainty, or is it the beginning of a longer-term structural rally? Is it going to last longer, as some sources are suggesting?
Yeah, one thing is very clear. The dollar and the US Treasury safe haven status has come under question after the trade wars starting. So a lot of that cash is going into Swiss francs, is going into yen, and it's going into gold. Gold overall, if you see, it's a $400-500 billion of net purchases per year. Out of that, if 40-50 billion come out of US Treasuries looking for a safe haven in gold, they change the complexion of the market. So that's what's happening. Now, all will really depend on if there is a big tariff agreement, then the bets will go back to equities and US equities and out of gold. If this trade war lingers, then gold will continue to outperform. So overall, bets are on both sides. I think we'll have clarity in a couple of months on this. But right now, what is the positioning? It is the most favored asset amongst fund managers and investors. Even the recent Bank of America Global Fund Managers survey showed that the preferred trade for 49% of global fund managers is long gold. So it's moved out after 24 months. The preferred trade has moved out of the magnificent 7 big tech companies of the US into gold. So that's a structural change, but a lot will depend on sentiment based on the global trade. So right now, gold is toppish, but we are not recommending selling out of it. We'll have to wait and watch for the next couple of months for the future direction.
Hear your point, Mr. Bagga, and as you correctly mentioned, that safe haven status that US equities held, and that is definitely a big question mark for most people, and a lot of people are now figuring ways out to keep themselves secured. As of now, as far as institutional investors are concerned, they are reallocating their portfolios in response to Trump's tariff policies. How do you feel they would be doing that, and what role is gold playing in that shift?
Yeah, money is moving out of the US market as far as institutions are concerned. The US retail keeps on buying the dip. So yesterday we had the commentary from a lot of US brokerages where they said their retail investors are continuing to buy the dip. Last week, the US stock markets stock funds got about $5 billion of inflows, even as outflows happened on treasury and bond funds of 25 billion and money markets of 16 billion, and money markets lost 25 billion in the US. So outflows from fixed income, inflows in equities still. But I think that outflow would have gone, some of it would have gone into gold ETFs or gold positioning. That's what's happening. So gold is attractive. As I said, 49% fund managers are long on gold. That's the preferred positioning in the global markets as per the latest Bank of America survey.
Understood. Now, sir, as far as what the Fed is carrying forward, if the Fed maintains a pause on rate hikes while tariffs continue to escalate, how do you think that dual dynamic will continue to shape demand for non-yielding assets like gold?
Right now, the US bond markets are factoring in 3 to 4 rate cuts this year. So anything from 75 basis points to 100 basis points, that's also helping the gold price. So in case the Fed doesn't cut in June or July, then you could see a correction in gold. So a lot of the Fed rate cuts are based on a recessionary US economy or a slowing US economy are baked into the gold price right now. So if the US economy does not show signs of an impending slowdown, then you could see a correction in gold. Right now, 3 to 4 rate cuts are baked in.
Understood. And Mr. Bakka, finally, I also wanted to quickly get your thoughts on the tariff rates that Trump had suggested. Earlier, it was reciprocal tariffs. When it was announced, he said it's going to be cut midway, half of that. And then finally, there was a 10% base point tariff and then a 90-day reprieve. Going forward, do you feel it's going to be more threats than tariffs, or do you feel these tariffs are going to match up with those threats?
For the two biggest blocs, China and Europe, there is no breakthrough yet. So it's all on tenterhooks. We don't know the end game that Trump and his administration have in mind. Yesterday, the European Union trade representative spent a day in Washington, but he had to leave with saying that there is no clarity on what US wants. Trump yesterday invited China again that come talk to us. China is not engaging. They put a ban on further purchases of Boeing jets by Chinese airlines, for example. So China is clearly in a mood to escalate. Trump has already escalated. He's given reprieves like on the electronics going back to no tariffs, and for China 20% tariffs instead of 145%. So Trump has been giving these kind of reprieves based on the domestic situation in the US. But unless there is movement on a tariff agreement with China and Europe, it's very difficult to say. And right now there is nothing happening. Europe has been disappointed. They were looking forward for movement on, at least to understand what does the US want. US is very clear that it wants to decouple the rest of the world from Chinese goods. So that Europe cannot afford. It has a massive trade with China, and it depends a lot on Chinese goods. There's nobody which can supplant those goods coming from China at that quality, at that price point, at that reliability. So there is a logjam as far as Europe-US and China-US goes.
And China has made it clear they're going to fight it till the end. They're not going to get bullied into anything. US wants China to make that first move towards coming to the negotiating table. China saying nothing doing. They're going to have it their own way. Of course, these are the top two economies in the world. It is going to have an impact on the rest of the world as well. We need to wait and watch on this. Thank you so much. That was Ajay Bagga joining us from Mumbai. Always a pleasure speaking with you, sir.